Hey everybody, welcome to this week's Middle Class Investor. This is Seth Martin, and we are looking at a chart of the S&P 500, a weekly chart, and you can see here that we had a really kind of a flat week. I mean, we closed about where we opened, but the market rallied pretty high before selling off and closing about where it opened. But one of the things I want to point out here, and it's kind of hard to see on the weekly chart, you've got a large down move here. We talked about this last week, and then you got another large down move. In fact, I tell you what, let's go look at this on the Dow Jones Industrial Average, and let's put on the volume, and I want to look at this in the context of volume, which I think is a good way to look at this. And we might not be able to get it all. Yeah, I think we can get it mostly there on the same page. All right, so you had this big down move, and notice it coincided with, this rising volume. Now, the volume wasn't rising a lot here, but then it dramatically rose right here on this move, and then notice on the up, back up into here, the volume was dropping off, and then with this candle right here where it started to sell back off, the volume rose. So what are we seeing? We're seeing on these big down moves, well, not so much here, we saw a little bit of increasing volume here, but more importantly, on these up moves, we're not seeing a lot of a high volume. If you look right here, this right here is actually on declining volume. This up move right here is on declining volume. So these are some of the more subtle things you have to look at if you want to kind of read between the lines, so to speak. Now I'm going to go to a daily chart. We're going to stay on the Dow, but I'm going to go to daily chart. And actually, let me go back to the S&P 500 and just look at the just the big picture, with the channel and everything. Let's just take a look at that, and then we'll come back to the Dow because I really want to look at the Dow. But you can see this channel has been holding for a long time. I mean, if we go back, we can actually go back even further and see this channel goes all the way back to the March 2009 low. But if we zoom in a little bit, if we go to the 5-year and then zoom in on this blue channel inside of the red channel, you can see that we were right on the line. And like I said, we're showing some cracks in this right now, and then this is potentially a very bearish candle. So if you get any kind of close lower next week, like below this low right here, then this is a bearish topping tail. And if we go to the daily chart, we'll analyze this a little bit more. And in fact, I think maybe the best way to do it is just go to the EWI charts because they do such a good job of charting. Let's look at the short term. So this is the Dow Jones Industrial Average daily range, and you can see here we had this big down move. Let me see if I'm not going to be able to get all this on the same page here, but you can see we had this big down move. Then we had this A, B, C for a 2, and then we had another down move, but not as big, and that's because um, this move is one less degree of trend. But then we had an A, B, C flat for the next degree too. So in other words, this one down corresponds to this two, and this one down corresponds to this two. So we've had a kind of a large degree 1 2 1 2, and of course the next move is 3. In fact, they show 3 has already started here. We zoom in a little bit more on this. You can see that each day this week on the down days, they got bigger and bigger. The ranges got larger and larger. This is something that is pretty typical in a wave 3. We might, for example, next week we might open up a little bit. The market might open, somewhere up in here, maybe about where it closed, maybe slightly higher, and it could run up a little bit, and then turn around. So let's say it opens right here. Well, that's the close, and then let's say it runs, but then this candle will be longer, usually, than this one. So then you get a close down here. Also, if you start getting closes toward the end of the day, in other words, there's not much rally, like these candles here, this is very bearish, where you get a close near the low of the day. This one's very bearish, and you can see the close is right here, and then look what happened. It got down and then ran way down the next day. So wave 3 action, also you'll get gaps on wave 3, so you could just like this right here, you get a gap where we open up here and come down, so on and so forth. So if in fact we are in wave 3, you're going to see this market really start to sell off very quickly. And the thing I want you to notice is how they'll just be grasping for straws as to why this is happening. This is one of the reasons I was attracted to this Elliott Wave stuff. To be honest with you, it's hard to use for trading, but it's very good for knowing where you are in the larger degree trend. For example, Prechter put out this. He basically says, look, there's a high probability that the wave 2 rally is over, and he makes a case for it in here. But he's been tracking this now for a couple years, and has known that we were somewhere in wave 5. And the thing about it is, even if you can't get the very top, if you know you're in wave 5, you need to start trimming down your positions. And that's one of the cool things about Elliott Wave. And the other thing is, anytime you have a 3-wave move, the final C, so you can see it right here. So if you look at this is another thing that's kind of interesting about Elliott Wave. You can see there's an A, B, C here, okay? And this C here, it really, it maybe doesn't look like 5 waves. So that kind of tells you, well, this isn't over. And then we get this X wave, and then you get, now this was a little bit of a head fake here because you had this ending diagonal here, which was an A wave for the next, for the double zigzag or whatever. But then what's cool about this is, if you can see this 3-wave, the final wave, and even C, is always in 3s. So you kind of get this wave 1 up to here, and then 2 down to here, and then 3 up to here, and this little 4 here, and then a 5. So even in the C wave, you can kind of wait for wave 5 before you, let's say, go short or go long, depending on which way this is going. And and if you're wrong, let's say it comes down here and then rallies right back up and breaks this high, well then you're just out. You're not short. But you can go short here with a real small risk area. Like your risk is what, like here to here, okay? But your reward is from here at least down to here. And so these make for really good trade setups, and you know, it's a good tool for seeing where you are in the larger degree trend. Because sometimes the market can be very confusing. Since we're looking at this, I want to just go to the bond market. They usually comment on the bond market. So here's the 30-year U.S. Treasury, and you can see here's your wave 1, here's your wave 2, here's the top. This was the top of the bond market, and we've got this, you know, wave 3 has already begun. So we've got 1, 2, 3, 4, 5. So this is a wave 1 of a larger degree 3 that'll play out. So you can see here that the bond market yields really went up this week because the bond market really sold off. So if you still got money in a bond fund, you really need to think about taking that out. Of course, you get to decide, it's your money. The other thing is, I really like Peter Schiff, but I think he's wrong about the dollar here. The dollar has been going down for more than a year now, and he's talking about it crashing. I think what he's looking at is he's looking at this sideways move in the dollar, and he's thinking, okay, it's consolidating, you know, kind of consolidating, but the trend is down, so you know, when it breaks out, it's going to break out to the downside and go even lower. And I just don't think that's going to happen. You know, crashes don't happen after long periods of this. The crash kind of happens earlier, and this is not a large enough degree trend yet for a crash. Now, I think Peter's right. Eventually, we are going to have some sort of crisis in the dollar, but I don't think it's imminent right now. Same thing with the euro. The euro's been going up, so the likelihood really is that the euro is going to be selling off, and so we'll look at another chart of the euro in a minute. But basically, you know, they've got it mapped out here pretty good. So we should see some sell-off in the euro. You know, first down to here to this 1.15 area, but if it breaks this 1.15 area, it's coming all the way back here to, you know, near parity. So we'll look at the euro again in a minute. The other thing I want to look at, this is gold, or I'm sorry, this is silver, and you know, it's very complicated looking what it is, but what's happening is, you know, it looks like silver is going to rally quite a bit here, and I would say at least, you know, maybe north of this 2117, and maybe significantly past that. Gold is also in a bull market short term. The larger degree is down. Larger degree trend is down. You can see here there's this A, and we're working through some sort of B, maybe up to the 1600 area, and then you know, we're going to sell off back down past this area on gold, so below 680.75. Now that, you know, it may seem unbelievable actually that could happen, but that's just what the chart is showing us at this moment. I mean, it could change. You know, a better pattern could emerge, and we may have to change our forecast. But that's what it looks like right now. All right, back to this. Let me go back to the Dow Jones. The reason I like the Dow Jones a little better is is it made a lower low here, whereas the S&P did not. But you can see it still has that same topping tail. And anytime you see that, that's also known as a doji. What you're looking for is some sort of close below that low there to tell you that this little uptrend is over. Now you can go to a shorter time frame. In fact, if we go to a daily, let's just go to a 2-year daily. You can kind of see that the trend has already begun to change, and that's a good point. We ought to spend just a moment talking about that. So so if you're looking at let me hold on a second. I'm not sure what I did. Messed something up. Okay, there we go. Zoom out a little further. Now we'll zoom in because I want to get this whole trend on the page so you can see it. So I'm going to kind of go through kind of an obvious deal here, but we have, the market ran up into this high, sold off pretty aggressively. I mean, there was a lot of fear here. This is where the VIX went to 50 and made a low, and then rallied up and made a high, but it's a lower high. Okay, so right here we had the potential for a trend change, and we still have the potential for a trend change, except this is a higher high. Okay, that's a higher high than this high, but then we went up and we made a lower low. Again, potential for trend change. And then we ran down and made a lower low. So now officially right here, you could say that the trend has turned. And so what we would expect is we ran up to make a lower high. So each one of these highs is lower than the previous high. And what we'd expect now is that this would at least go down and make a lower low. Okay, and if this is a wave 3, it actually will make a much lower low, because that's just the way wave 3s are. The way a wave 3 works in a kind of an idealized pattern is you get a wave 1 down, you get some sort of correction in a 3-wave or ABC move up, and then wave 3 is very long, and then usually you get some sort of simple. It's about the same height as this, and then finally wave 5 makes a lower low. So we should see some sort of version of that in this. Now you may have to, in order to actually see it look like that, you may have to go to even a monthly chart. We may have to go to a 10-year monthly chart. Maybe that's a little much. Maybe weekly is fine. So you can kind of see down move, A, B, C, down move, A, B, C, down. So there's a 1, 2, 1, 2 here, and then down. So just be very, very careful. This is where a lot of people end up having regret. They try to do some timing in here and get out and get back in and all this kind of stuff. And then here they're feeling pretty good. Of course, this last couple of days is shaking them a little bit. But we could get a 2,000 point sell-off next week in the Dow, and be down here somewhere, and then people have regret. That's what I should have got out and all this. It's just, we talked about it way back here. Is, what's the potential upside? Maybe 2, 3, 4%, but the potential downside turns out was 10, but it could have been even greater. It could have been 15 or 20%. you just don't know. So um, don't don't be greedy here, trying to get trying to hope that this gets back up here. The pattern looks pretty clear. I mean, it still could be wrong, but it just looks really clear. Here's some of the other countries. Let's get back to a 5-year chart. And again, that topping tail, you can see that on Germany, Japan, little less of a topping tail, but still kind of a doji. The United Kingdom, same, doji, topping tail. So everything looks like it's lined up in tandem, and that's probably not good. Let's look at the 13-week Treasury. Let's put it on, take it off log, and you can see this past week, actually the past 2 weeks, we've been riding up higher and higher. So this is just going to keep getting bigger. Now there's a lot of talk about what they call the cable, which is the 210 spread. That's just the difference in the yields between the 10-year and the 2-year. It's a pretty important gap in that interest rate, because that's the arbitrage that banks tend to utilize. So like if you're looking, for example, if you're looking at the 10-year Treasury, let's look at that real quick. The 10-year Treasury is at 2.95 right now. So the 10 years at 2 point, whoops. So the 10-year is at the 10-year is at 2.95. Oops, that's a crazy looking 5. And in the 2-year, I don't know right off the top of my head, but it could be, it might be at 2.4 or something like that, or 1.8. And of course, the difference between these is like this minus this is 550 basis points. So BPS. And this 550 basis points is kind of what the banks capture. So the banks have to pay out, to deposit holders a number like this. Although it's actually much lower than this. It's probably 1.4 here, not 2.4. But they loan money at this. So the idea is I loan long-term money at this number, and I pay out short-term money at this number, and of course I get to make the difference. That's why the cable is kind of an important spread, and it's really what's happening is the 2 is really catching up to the 10. Of course, the 10 will start taking off here soon. Let's see if I've got see, I don't have the 2-year Treasury on here in my list, so I'm not going to go looking for it right now, but suffice to say, with this 10-year really taking off, the spread is widening between these two. Of course, the banks can make more money, but I guess if it gets too great, there's some concern. The bottom line is you just need to look at this. Really the more important interest rates are the 13-week Treasury, because it tells you that the Fed's going to raise rates, and then the 10-year Treasury. This is the one where your mortgages are based on and things like that. So this is what they call the risk-free rate in the market. Of course, it's not really risk-free, because even if the government always pays you back, they're likely to pay you back with dollars that are worth less in the future. Um, that's why that's why debt works in the government's favor. Is because they can always just inflate the value of the currency away, so that people paying back the debt are using dollars that are less valuable in terms of purchasing power. Um, anyway, I think next week is going to be a very interesting week. Um, hopefully, you guys are prepared and ready to take some action, because we talked about the psychology of this, and that's really the dangerous part. Excuse me. Um, Especially if you're not coming to something like the middle class investor and you have kind of a heads up on the way things work. But as this starts to do stuff like this, maybe gap, like this. First of all, you start saying, well, I saw that topping tail. I should have sold right there. What was I thinking? So you're beating yourself up, which is not very proactive. But then there's this whole psychology around, well, I'll just wait for it to bounce, and then you get another move, um, like so. So, it goes down again, maybe gaps down really big. Of course, the fear's starting to get up, and you're like, I should have got out here. Well, I'll just wait till it bounces, because surely it's gonna make some sort of move back up, and then I can get out here. The problem though is that it doesn't make that move. It makes a little move like this, maybe, and then maybe back down a little bit. Maybe it makes another move higher, fills that gap. But then, and you're thinking, well, hell, maybe it'll go all the way back up. I'll just hold. And then the next day, you get a gap down and a candle like this, and then another one like this, and I mean, it just demoralizes you. So don't get caught in that psychology. Don't play that game. It's just a losing game. And the thing about the market is it takes the stairs up. This is the stairs, but it takes the elevator down. And so when it comes down, it really moves. And there's no way really for somebody who has a 401k to win at that game. There's just no real way to do it. So be very, very, very careful. Consider moving your money into money market account inside your 401k. Hold on to this capital, hold on to this cash, and wait for a better day. Now, when is a better day? Well, we've talked about this number right here, this 15,200. I wouldn't even think about putting my money back in the 401k until it got down to this 15,200 area. And it's going to go there pretty fast, so you'll get a chance to probably put that money in this year. And then we'll probably get, let's talk about if that happens, what can we expect? Because that's important. You got to have some sort of plan going into this, or you get caught up. Okay, so where's that 15,200? Well, that's right here, that on this blue line, which is now red. Okay, so let me just draw it over here like that. So this market's going to come down like this, and then maybe what it does is it comes down, let's say in a really strong wave 3, and then you get a wave 4 that corrects back up there, and then you get a wave 5 that comes down here. Okay, now remember, we got the bottom part of this channel right here. So where are we likely to bounce to? I mean, I would look for a bounce back up into this 18,500 area, or wherever this is at the time frame after this sells off. So we have to wait till this comes down into this area, find support, and then starts to turn around, and that's where we want to buy. But we want to be a seller when we get back to that trend line, wherever this trend line intersects with this trend line. So we're looking for the intersection of this trend line and this trend line, and that's where we want to become a seller again, because then you got the next move down. Okay. Now, the other scenarios we could it could go quite a bit higher. It could maybe go up here, because remember, this is the wave 4 high, so this could just be the first move. Problem is, you don't really know, and then the second move could be back up, to the wave 4 high, and then boom, down. Okay, so just like I said, I wouldn't even think about getting back in my 401k in equities until we got down to this 15,500 area. So you got a long way to be thinking about, what you're going to do. I wouldn't sweat it too much. I'd just sit on the sidelines and be thankful that you're not losing money, and you're not losing sleep at night. All right, everybody, I'm going to cut it off there, because really, we can talk about the same stuff over and over again, but we really need to see a break of this low, a break of this low right here, and then have this thing start selling off. And then we'll be able to pick a place. Okay, here's where it's likely to stop and bounce. And I'm sure you guys will pass around the program more often once that starts happening, because that tends to be the way things work. Once something starts to sell off, people start looking around for people that have been talking about that, and try to understand why they were talking about it, so they could learn something from it. Unfortunately, most people are trying to learn stuff after the fact. So all right, everybody, that is it for this week. Thanks for coming in. Come in next week, and we'll kind of evaluate what we have. We should see, we might see a little rally early in the week, but then probably sell off the rest of the week, and it could be significantly lower, 400, 500, 600 points or more. Okay? All right, everybody, take care. Bye-bye.